Average due date. Average due date is a single figure amount can be paid in ratio of several by the drawer on the drawee, payable on different dates to discharge his liability. Both the parties may feel it inconvenient dates. As a solution, a mean date is calculated for a lump sum payment of interest to the drawer, nor any undue advantage to the drawee. The average due date technique of payment may be used in the following. In connection with the settlement of contra accounts, that is X, and different dates. In the settlements of accounts, in calculation interest on partners drawing, in calculating interest on book debts which is realized. Steps for calculating of average due date. Step 1. Select one of the due dates as the base date from which calculation are made to be. Any due date may be taken as base date, but preferably we should take the first due date as the base date. Step 2. Calculate the number of dates plus or minus of each of the other due dates from the base date. Step 3. Multiply the amount of each payment by the respective number of days as calculated under step 2. Step 4. Add the amount of each payment and also add the products. You should add the amount of each payment and also the products. Step 5. Divide the total of the products by the total of amount payable. It is the formula. The result will give the number of dates which are added to or subtracted from. If the plus we need to add, or if it's minus we need to subtract it from the base date, and the average due date is found out. The final solution will be provided. If the due date is in the fraction, round it off to the next whole number. If any holiday, you should take the next day as a working day. While calculating the due date of a bill, the following points should be noted. When the period of the bill is stated in days, the calculation of due date will be in days, which includes the date of payment but excludes the date of transaction. The payment date will be included but not the transaction date. When the period of the bill is stated in months, the calculation will be made in terms of calendar months, ignoring the number of dates in a month. For example, if a bill is drawn on 15th January 2003 for 3 months, the due date on the bill is 18th April 2003. Third one, if the due date falls on a day which is a public holiday, for example Gandhi Jayanti, India Republic Day something, the due date shall be the preceding business day. And now, if the preceding day is also a public holiday, it falls due on preceding the previous day. If the due date of, for example, if the due date of a bill is 26th January, it's an Republic Day, it's a government holiday, it falls due on the 25th January. And if 25th January is also a public holiday, if it will fall due on 24th January, provided 24th January is not a public holiday and it's a working day. If fourth one, if the maturity date of a bill of exchange falls on a day which is an emergent holiday declared by the government and the President of India as per the Negotiable Instrument Act 1881, the date of maturity will be the next working day. If there is an holiday, we should take the preceding day. If there is an emergent holiday, we should take the next working day. Due date of a bill of exchange. A bill of exchange payable at site comes due immediately after the bill is presented for payment. While we present the bill for a payment, it will become the due date. A bill of exchange payable at a predeterminable time in the future becomes due on the expiry of the period of bill. It is also called as maturity date of the bill. The time after which the term bill is to be paid is said to be tenure of the bill, but it is customary to allow 3 days of grace to the drawee to pay the amount in case of a term bill. Therefore, while calculating the due date of a term bill in its period for which it is drawn, 3 more days are added. For example, a bill is drawn on 1/1/2003 for 3 months. The due date is 4/4/2003. Let's see an example sum related to the average due date. Uh, Kanan purchased goods from Raman. The due dates for payment in cash as being as follows. Kanan made a transaction with Raman, and Raman agreed to draw a bill for total amount due on the average due date. Due to several days of payment, they concluded the average date to get a total payment. There are totally 4 days given. March 15, April 21, April 27, May 15. We should not take the dates as a due date. We should take the third column, due 18 April, due 24th May. So we should keep the amount as same, and then we enter the solution. Computation of average due date. We should take the base date as the first date, which is given as 18th April, and there should be four columns. We should separate four columns. First column is due date, second column is amount, third column is number of days from base date, fourth column is products. First column we should enter the all respective due dates: 18th April, 24th May, 30th June, and then 18th July. Amount, we should take the amount from the question and write it respectively, and we should calculate the total of amount, and the number of days from base date we should calculate 0 for the first base date, as number of days and product is 0, and we should calculate it from the second date. From 18th April to 24th May there is 36 days difference, and then from 24th May to 30th July there is 73 days difference, and from 30th June to 18th July there is 91 days difference. So we should take the column 2 into column 3, so it comes 1000 into 0 1000, sorry 0, 1500 into 36 is 54,000, 500 into 73 is 36,500, 600 into 91 is 54,600. The total of amount is 3,600, and total of product is 1,45,100. The basic formula for average due date is equal to base date plus total of products by total of amount into calculated by dates. 18th, we take the base date as 18th April, and total of product is 1,45,100, and the total amount is 3,600, which comes 18th April plus 40 days. We should be added the calendar days from 18th April as well as April, May, June, as it comes average due date is equal to May 28. Thank you.